I'd like to welcome my guest, Steve Forbes, back to the show. Last time I had Steve on the income generation, we had an encouraging conversation about his new book entitled Reviving America, how to repeal Obamacare, replace the tax code, and reform the Fed, and how that will restore hope and prosperity. This morning, Steve, we're talking about corporate short-sightedness. We've been talking about decisions at the top levels of corporations that are often driven by what's best for the executives, not necessarily for the customers or even the long-term outlook for the company itself. But before we get to business, I want to tell you, Steve, that you make me feel like I'm back in Catholic school again. Do you know why that is?
No, I'm not wearing a nun's outfit, so.
No, you're not. Thankfully, you're not. But do you have a screen there in New York in our studio where you could see me by any chance?
No. So I have to take you on your word.
Well, you see, I learned after our last interview what a gentleman you truly are. Do you have any clue why that is?
I sent you something?
Yes. You see, normally a host should be so grateful for having the guest that the host should send a gift to the guest. In this particular case, the guest sent a gift to the host. And I don't know if you've seen any of our commercials, but we've had a little fun with a commercial, Steve, where I talked about all the reasons why I will not wear a necktie on the Income Generation show. But I decided today was the day that I had to break my rule just for you. And if our camera crew could help me out for just a minute, I'd like you to zoom in here and take a look at the tie that was a very gracious gift from Steve Forbes. Written all over it, of course, the capitalist tool. And you, like me, I know, Steve, are certainly a capitalist. So let's
this makes you the best dressed person on the earth today.
That's right. That's right. I feel well dressed. Thank you very much. Listen, you know, we have the best system in the entire world in terms of capitalism. But what we're talking about today is the fact that it's not perfect. And first of all, I know you agree, but if you want to share in your own words for a moment with our viewers why you believe that there's a little bit of an issue, or at least a little bit of an issue, with corporate myopia in our country given our current system.
Well, I think what you see unfolding today, whether it's in the corporate boardroom or other aspects of the economy, is what happens when you have bad economic policies. The system doesn't work when you keep making mistakes, whether it's undermining the dollar, binge spending, regulatory tsunamis, which are especially harmful to small businesses. So people respond to the environment in which they find themselves. And today we don't have real free markets, as you know, and we've discussed this before. Mm-hmm. Free markets, when allowed to operate, always turn scarcity into abundance. And we see that whether it's flat screen TVs, cost $10,000 or $15,000 a few years ago. Now it's a few $100. Smartphones, first one from Motorola, $3,995 30 years ago. Today, many plans will give the things away. Soon they'll be $50 if you want to buy them retail. Whole world at your fingertips. So when we look at what's going wrong around us, the origins, I think we have to get policies right, and then I think we can more successfully attack the shortcomings that we see out there.
Now, of course, there's been rumors in Washington where they seem to be trying to solve this so-called problem by curbing CEO compensation even more than it is currently. What effect do you think would that have if that ever made its way through?
Well, what you see in Washington often is what you might call the Washington version of whack-a-mole. They see a problem, they don't realize the origins of it, so they whack it, and then more problems rise up. A good example, talking about CEO compensation, back in the mid-1990s, soon after he took office, President Bill Clinton decided CEOs were making too much money, so they put a cash cap on CEO pay of $1 million a year. And they wrote it in such a way that lawyers had a field day, but what that led to was then a huge emphasis on stock options, and we know where that led. So the key thing is, in terms of reining in rampant CEOs in addition to boards of directors, is this shareholder activism that we see out there. Not all of them do well, these activists, but they do put a little bit of the spotlight on what they think are CEOs who aren't performing.
I know your philosophy on taxes and capital gains taxes specifically, but for our one or two viewers that may not have tuned in the last time you were here on the show with us, tell us what you think a change in capital gains rates would do to this corporate myopia. Would it be a positive? Would it be a negative?
Well, if you did the whole thing on the tax code, and I think we're starting to get a real discussion of that, and junk the tax code and put in something like a simple flat tax, sharply reducing the capital gains levy or getting rid of it altogether, as some countries are doing now, you would see a wholly different environment. Right now, when you have a sluggish economy, it puts the emphasis on what you might call financial engineering, which is buying in stock, great for the shareholders, but not often the best use of capital. Mergers and acquisitions, sometimes they work out, but that's not the same thing as starting new businesses, really vigorously expanding existing businesses. So when you get a tax code that does not reward success, that punishes you if you start to earn more money, you get a distorted, deformed economy. And that's what we see playing out today. If you're on salary, given this current tax code, as you know, it is very hard to really accumulate capital. It punishes people who need all the removal of barriers, all the incentives they can get to move up the economic ladder. It's a rigged system, and it's rigged in a way where cronyism, who you know in government, soon counts more than what you do in providing things that people want in the marketplace, new products, new services, improving existing ones, making them cheaper, better, and the like.
That's great. Cronyism. I want to talk about that a little bit more after the break. We need to take a quick commercial break now. Stay with us. We'll be right back with more from Steve Forbes. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back. I'm here today with my new friend, someone who needs no introduction at all, Steve Forbes, author of the new book, Reviving America, How Repealing Obamacare, Replacing the Tax Code, and Reforming the Fed Will Restore Hope and Prosperity. Steve, see how simple it is? All you have to do is get me a simple gift, and I consider you a friend for the rest of our mutual lives. Isn't that amazing how simple I am?
Well, reciprocity.
That's right.
Makes for a much nicer world.
That's true. See, you put me on the spot here. Now all of our viewers know that reciprocity is what I need to provide at this point. Listen, right before the break, we talked about taxes, and you had insinuated that having a reduced capital gains tax or even eliminating capital gains tax as other countries might actually be something that gets corporate CEOs and executives to focus a little longer term. But also, even just having a differential between short-term and long-term. You know, if they pushed long-term capital gains rates out several years, wouldn't that also help to a certain degree have people be a little bit less myopic in corporate America and a little bit more long-sighted?
Well, you have to recognize that people have different investment objectives. And some investors want to do companies that are starting to prove themselves. They want to hold them long-term. Others just want to get them, especially in venture capital, get them out there and then take the money out, do an IPO, and then go on to the next one. So the one formula doesn't fit all. But one of the things that I think shareholder activists have to put more emphasis on is that CEOs have to do a better job of explaining what exactly is their strategy. Why should you put money in that company? The classic best example today is Amazon. Amazon made it very clear at the beginning, Jeff Bezos, the CEO, that they were going to pour every cent, every dime of capital they could get. There'd be no dividends. Profits were going to be skimped. They were going to pour everything they could to rapidly grow that company. So even though on the profit side, Amazon hasn't had much in the way of profits, Jeff Bezos made it very clear they're going to grow the top side, the revenue side, and go hell-bent for leather, as they used to say, and make that company a retail giant, innovating in terms of delivery and everything else. And occasionally when expenses got out of control, he pulled back, got expenses under control, and then went roaring ahead. So the fact they don't deliver much in the way of profits, investors know that, but they see the top line growing, they see the innovation coming, and so the stock has done extremely well. By contrast, for years, IBM was doing very well, and then went a little overboard on the financial engineering, using all their cash to buy in stock. So even though the top line was not doing well, they showed a good bottom line, but it was short-termism. So shareholders have to, CEOs, part of the obligation they should have is putting out there what are their objectives, what are their metrics, what should you expect. And you see this really, David, in healthcare. A lot of these startups, they'll tell you for a while it's just going to be absorbing a lot of cash as they develop a couple of new drugs or medicines. And if it hits, you're going to do very well. But in the meantime, you're going to know it's going to require a lot of investment before this thing can be brought to market.
I think that's an important point, because when you talk about all the financial engineering, you could financial engineer the bottom line, the profits, but you can't financial engineer revenues. You can't fake it. Either revenues are coming in or not. How about if somehow that if bonuses were tied more closely to the top line? How do you think that might change the motivation of today's CEOs and management teams?
Well, this is where it gets to be not a science but an art, and this is where the compensation committees on boards of directors need to be held, have more of a spotlight on them. And that is, if you're going for growth, okay, good, grow the top line, but don't do so in a way where your expenses are going to end up undoing the company. And that's what Bezos has been, Jeff Bezos of Amazon's been very good at, making sure that the top line grows without wrecking the company. And so you have to have various metrics in there to be sure that focus on one thing doesn't come at the expense of everything else. And this is where startups often get in trouble. They see, sales are doing very well, but they lose control of their cash flows. They don't do that very well, and boom, they're successful, but they go broke. They don't understand why. Sure. So you got to tailor it to the specific company. And that's what we need more of, this kind of fine-tuning. What are the proper metrics for the company at that particular time?
I agree completely. You'd mentioned before the break, cronyism was the word that you'd used, and some call it special interests or lobbyists. And in this political year, I know you're no stranger to politics, so in this political year, what do you think could be done to help solve this problem from the special interest side, the cronyism side?
Well, in addition to more transparency, the key thing is, and this is a mantra that we haven't been very successful in enacting, is make government smaller. If you have a large government that becomes more and more involved in more and more aspects of our lives, more and more businesses, I mean, whoever would have thought that Washington now would be trying to control the internet the way they did the dial-up telephones back in the 1930s. It's really starting, it's going to be a real dampener on the growth of the internet in the future, where you got to get permission if you want to start a website and that kind of thing. And when you have that kind of more and more regulation and that kind of top-down attempt to control people, you're going to have to lobby Washington. Otherwise, they'll kill you. You reach a certain company size in this country, and if you don't have lobbyists in Washington, the political class will come and exact tribute from you. They will come and get you. It's a hideous system we're developing today. So that's why we got to pare back in government, not safety nets, but this regulatory blizzard that we're going through now, where they're trying to control everything we do. You get up in the morning, they want to tell you what to do, and it's ridiculous, but they'll do it unless they're stopped.
Great. Well, you heard it straight from my new friend Steve Forbes. Smaller government, not bigger government is the answer, and I think most of our income generation viewers would absolutely agree. Once again, it's been a real pleasure.
By the way, a good way quickly, David, to think about it, if you complain about mosquitoes, drain the swamp. That's how you get rid of the mosquitoes.
That's right, solve the problem, not the symptom. Agree completely. It's been a pleasure having you on the show once again. Thank you.
Thank you.
And now you have the entire income generation holding me accountable for my new word of the day, reciprocity. So stay with us. We'll be right back after the break, where Morgan and I go one-on-one to talk more about corporate myopia and maybe even come up with a solution or two beyond what you heard today from my new friend Steve Forbes. We'll be right back. Stay with us.